Echelons of Wall Street, I spoke to James Gorman, the co-president of the big investment bank Morgan Stanley, and a Melburnian who's been living in New York since 1985. He now runs the world's biggest brokerage, employing 18,000 advisors after Morgan Stanley bought Smith Barney from Citigroup this year. James Gorman, you're Australian, so you'd be familiar with the fact that in 1998 the Australian government moved regulation of banks away from the Reserve Bank, the central bank,
yes,
to central prudential regulator. What do you think of the fact that President Obama has gone the other way and he's moving the regulation of the major banks in the US to the central bank, because the Australian systems work pretty well?
Well, but there's big difference, isn't there, Alan, with the Australian system, because in the US we have, at this stage, 4 or 5 major regulators: the OCC, the Fed, the Office of Thrift and Supervision, the FDIC. So I think what President Obama is doing is consolidating with what is probably the strongest of those regulators in terms of overall risk oversight, which is the Federal Reserve.
But most of those regulators you mentioned still exist.
Well, one of them just disappeared last night.
But that's only the thrift regulator.
Correct.
But so it doesn't seem to have reduced the complexity or the potential for regulatory arbitrage in the US.
Yeah, it's a start, but I think what he's created effectively is the first among equals. So the first step is consolidate overall systemic risk regulation with the Federal Reserve. Second step, presumably and hopefully, is ultimately to consolidate the number of regulators, make it a more efficient system.
Why not do it all at once?
Well, politics, as you know, is a complex process. So I think sometimes a journey of 1,000 miles begins with a single step.
One of the writers in the New York Times remarked that if Mr. Obama wants to create a regulatory environment that lasts 6 decades, as President Roosevelt did, what he'll have to do is what Roosevelt did, which was to make some bankers mad. So you don't seem to be mad.
I can't speak for all bankers. There may be some mad bankers.
No, but the bankers on the whole, including perhaps yourself, but on the whole seem to support the proposed reforms. Would that be fair to say?
Well, listen, we've come through a catastrophic shock to the financial system. A number of leading institutions in securities and banking have failed. And credit-based institutions, so whether it's Countrywide, whether it's Lehman Brothers, Bear Stearns, Wachovia Bank, Nat Citibank, large institutions have failed. We've had systemic risk problems. It's in everybody's interests, market participants, shareholders and taxpayers and the regulators, to ensure we have a stronger system. So the steps President Obama has taken put us on that path.
Should Wall Street and bankers like yourself take responsibility for what happened?
I think everybody has to take some responsibility. I mean, ultimately, at the root of the issue was there was too much leverage in the system. The US government was over-leveraged. The local municipalities and states are leveraged. The financial institutions were leveraged. Corporations were leveraged. And individuals were leveraged. In the last couple of years, Alan, we've had negative savings rates in the United States while consumer debt has been growing. So absolutely, all market participants, including our own, are responsible for the amount of leverage in the system, which ultimately is what brought down the financial system.
You mentioned the government was over-leveraged. It's even more leveraged now, and getting more leveraged by the year.
Well, I think what the government's done, Alan, is make a strategic decision to invest in the system, to provide extremely aggressive fiscal stimulus. And frankly, so far, I give them an A on their report card. I think the results are beginning to show. I believe the economy has bottomed from where we were potentially heading. So it would be easy to criticise them at this point, but frankly, I think they did what was courageous and right.
Just back to the banks, a lot of people say that one of the problems that led to the crisis was the repeal of the Glass-Steagall Act in 1999, which kept apart commercial banking from investment banking since 1933. Do you agree with that? Do you think that Glass-Steagall should be reimposed, should have been reimposed this week?
No, I don't. I think, frankly, it's a side issue. I mean, if you look at Freddie Mac and Fannie Mae, you look at AIG, you look at Wachovia Bank, the 4th largest bank in the country with $400 billion of deposits, none of these were affected or in any way involved with Glass-Steagall, either the original creation of it or the ultimate rebonding of banking and securities. The issue was not just the leverage, it was the quality of the asset which was levered. And in the United States, that asset was various forms of mortgage-related product. That had very little, in fact, to do with Glass-Steagall.
Well, what about the fact that the commercial banks actually did take on more leverage when they moved into investment banking?
Well, but the commercial banks had leverage as it was. It didn't change their overall profile dramatically.
But didn't they go from sort of 12 or 15 times to 30 or 40 times?
Sure, there are commercial banks that have had 60 times leverage, but the first major bank to effectively fail, which was Wachovia Bank, had leverage of 10 times.
Wall Street bonuses obviously have come off a lot. I think you got nothing last year, as an example. Is it the aim of people like yourself to get them back? I mean, most investors, I think, now sitting where they are and looking at their portfolios want to get it back, what they've lost. Is that the way people like yourself feel now?
Well, no, I mean, step back for a little bit. I mean, we volunteered a couple of the senior executives at our company to take no bonus because we felt it was inappropriate given what had taken place in the market and frankly, our company's role in that. You have to fairly compensate people. What hopefully the system which is now putting in place is more compensation in the form of equity and more compensation which has clawback provisions. So if somebody creates a problem which isn't visible for a couple of years, we have the right to go and claw back that compensation from the individual. Ultimately, though, if you're in a highly competitive industry, which all of financial services is, you have to pay people competitively. Not excessively, but competitively.
Do you think they were being paid excessively?
There's no question. I mean, there's no question.
So will it ever get back to where salaries and bonuses ever get back to where they were?
I think it's improbable. Certainly on a system-wide basis, I think it's extremely unlikely, and I don't think it's necessary. I mean, the gap between what CEOs were getting paid and what the average employee was getting paid, frankly, was out of all bounds. And it wasn't just the large public companies. It was the asset managers, it was the consumer credit firms, it was many of the regional banks, and it was other market participants.
Do you think it's a question of morality?
Morality in business is that's a tough definition of whether this was a moral issue. I think it was inappropriate. I think there were clearly people who were excessively greedy. There were people who brought their companies to the brink and sometimes over the brink of disaster and took massive severance packages as they walked out the door. Is that moral? No, that's not moral. But the overall size and shape of the compensation system, I don't think was bedded in immorality. I think there was greed, there was excessive risk, and there were, frankly, too much credit given to individuals who are playing with other people's money.
Do you think, on a global basis, there are lingering risks in the banking system now, particularly in Europe?
Well, I think that there are always risks in the banking system.
But anything kind of significant that is still waiting to, any accidents waiting to happen?
I don't think so. I mean, the two probably largest continuances or unknowns in terms of risk in the system at the moment is the continual decline in the commercial real estate market, particularly in Europe, in addition to the US, less so in Asia. And secondly, the exposure a lot of the banks have to Eastern European corporates. So I think they're the two things that are still being sorted through. Now, having said that, we still haven't seen the full impact of the consumer credit cycle waving through. You can't have, in the US, 10% unemployment, which we're well on the way to having, and not have major consumer credit defaults.
I mean, how do you think Australia now sits?
I think Australia sits very well. I think the banking system is very strong and has by and large been prudently managed. I think having strong, large, at-scale competitive institutions with a dominant focus on their home markets is important. I think the regulators have performed very well in Australia. The country's obviously had the benefit of a 10 to 15-year commodities boom. So there's been a lot of money flowing around the system. The government has been running surpluses. It's been a very attractive environment to be doing business.
Morgan Stanley has taken over the Smith-Barney broking operations of Citigroup, which you now run. What are the plans for that to be merged in Australia, and how will that operate?
Well, firstly, Alan, it's an organisation now of about 18,500 financial advisors around the world. We will be the largest wealth manager as a result of this deal, which obviously we're very excited about. And one of the nice benefits of it is that we have picked up an operation in Australia, the Smith-Barney operation, which will now be merged with our business here. And this gives us a tremendous platform for growth. It's the first time we've had a serious retail presence. We like the Australian market. We're convinced the wealth management opportunities here are substantial and will remain that way for decades to come. And if anything, we'd be looking to be an acquirer, either of individuals, talent, or of organisations to continue to grow.
And you mentioned acquisitions or possible acquisitions. Is that in broking or asset management?
Well, the initial focus is on broking. We now have something that gets us to scale in a market which is probably overbroked, and there are too many institutions in the space. So there'll be a natural consolidation, particularly as this recession continues to work its way around the world. So I think over the next couple of years, if we can find appropriate consolidation opportunities, we'll act on them.